Good morning, ladies and gentlemen, friends and members from Switzerland. Good evening for the friends from Asia. My name is Urs Lustenberger. I have the pleasure to host today's meeting or webinar. We will be interrupted every now and then, I presume. The background of today's meeting stems from an event of August 5th, when the Japanese markets went haywire. The topics dropped for 12%, and the rest of the world started to notice and went haywire for a day or two. This served for me as a stark reminder that Asia does exist and that Asia does have an influence of on the international stock markets. And this was the moment where I thought we should try to have a webinar like the one today. Of course, by now, we are more than a month later. Everybody has forgotten about the August 5th incident. The world has moved on. The markets have recovered. And nobody probably does even remember the event. Still, I think Asia is growing in importance, and the Asian markets are growing in importance. And this is why I thought it would be time for a stock taking to see how the markets work and how they influence each other. We have today a very distinguished set of speakers, and I will quickly introduce them as I hand the word over to them. We start with Kiat-Seng Shea from Singapore. He is a distinguished expert, managing director and CIO of Millennia Investment Management in Singapore. He has 30 plus years of experience in Asian equities and real estate fund management. He has helped build Morgan Stanley's Asian equities assets from 400 million to 4 billion and founded and headed Morgan Stanley's Asia Real Estate Securities Investment Group. Mr. Seng has been a founding principal of Forum Partners Asian Real Estate Private Equity Funds with investment experience in Asian markets, including Greater China, Korea, ASEAN, India, Japan, and Australia. Mr. Seng holds an MBA with honors from the University of Chicago and a bachelor's in property administration from the University of Auckland Valedictorian. Kiat-Seng, the floor is yours.
First of all, I'd like to thank Swiss Asian Chamber of Commerce for inviting me to participate as a panelist to discuss Asian economic outlook. Quickly, as a background, I run an investment firm called Millennia Investment Management based in Singapore and regulated by the MAS of Singapore. Today, I basically like to cover the following. Firstly, some general comments on the Asian economies, growth prospects and characteristics. And given the diversity of the region, probably useful to also briefly touch on the different parts of the region, namely ASEAN and Japan, as well as China. Secondly, I will briefly talk about the state of the Asian equity and very briefly real estate markets. And thirdly, to wrap things up, I will share some of the investment thinking we are currently working on to hopefully fully take advantage of the investment opportunities that are unfolding across the region. First of all, ASEAN. As we all know, ASEAN comprise 10 states with more than 680 million people, and ASEAN generates more than close to 4 trillion GDP. And in fact, by 2030, the ASEAN bloc is likely to become the 4th largest economy in the world, overtaking Germany. ASEAN growth is really supported by 5 key pillars. First of all, favorable demographics. It's important to note that there are 60% of ASEAN population is under the age of 35. And secondly, infrastructure development that is driving urbanization and growth. Thirdly, there is abundance of natural resources within the ASEAN region. Fourthly, ASEAN is really beneficiaries of global supply chain diversification arising from, the rising geopolitical tension between US and China. And lastly, obviously, ASEAN, offer quite a lot of attractive tourist destinations across the region. On the GDP growth, ASEAN as a region this year is likely to be growing in a region of about 4.3 to 4.5%. It is also worth noting that economic growth driver for many of the ASEAN countries are their domestic sectors, as opposed to the more export-oriented industries or countries in the North Asian markets like Korea and Taiwan. In fact, intra-ASEAN trade has also been a major growth driver over the years and now account for about 22% of the total ASEAN trade in goods, which amount to just under 4 billion. So 4 billion. In fact, surpassing other partners, including China at 18% and US at roughly about 10, 11%. Now, let's go to China very briefly. I know Professor Aoyang will cover China in greater detail later, but I just like to, mention a bit about the economy. We know that interest rates in mainland China, are really moving in opposite direction to those in the US over the past few years. And again, China is, really in facing a few challenges for the past few years. But yesterday's rate cut in the US will also provide more room for PBOC to lower rates to support the economy. And more cuts to lower the loan prime rate are likely by end of 2024 to probably around closer to 3.2, 3.3% region. Secondly, Hong Kong SAR, part of China story. Of course, Hong Kong Monetary Authority, given that Hong Kong dollar is pegged to US dollar, Hong Kong Monetary Authority has followed US to lower base rate via the overnight discount window by 50 basis points to now 5.25%. Now, quickly back to go to Japan. I think Japan is a major focus of many foreign investors in the past year or so. And I think the biggest story in the last few months really is the reversal of the yen as a result of the unwinding of the carry trade by many investors. As US rates were, rate cuts were in prospect, and as Japanese, Bank of Japan was signaling that they are, really going to hike rates from July onwards. Today we saw that, after the 50 basis point cut by Fed, yen, in fact, has actually recovered quite strongly. Obviously, it's a sell into the news, and as I guess investors reposition, the yen holding. I think going forward, we think yen is probably going to be range bound, at least for the time being. I think the key factors to consider is really the, basically the commodity prices, which actually drive up inflation domestically with a weak yen. But now I think with the weaker commodity prices, the pressure to high interest rate is probably less. And I guess with the inflation falling below 2% in July, I think the case to tighten is probably less so now. So in the market, we think the market does not expect a rate hike in the forthcoming September meeting. And I think the market seems to think that the probability of a hike this year is probably around about 20%. So the market participants are generally expecting BOJ to maintain the current monetary policy for the time being, engaging how the situation unfold. I think the other major factor to consider is obviously the election coming on September 27. I guess there could be a dissolution of lower house and general election coming. And if you look at the historical perspective, Japanese share prices could actually advance at the time of snap elections. I would now just quickly talk about Asian equity markets in general. I think Asian equities are generally more sensitive to US real rates, in the past. And in fact, as US interest rate falls and, with a weaker US dollar, Asian equity markets tend to do quite well. Of course, the exception is that, US doesn't go into a recession. So if there's a recession in the US, all bets are off. And I think the other important factor to note is that there has been broad-based earnings upgrade across Asia in recent times, in fact, led by Taiwan, Korea, and China. And I think only India and Hong Kong saw some downward earnings adjustment recently. In fact, in China as well, close to half of index stocks, had 20% year-on-year EPS growth forecast by analysts. And in fact, recently there's also a 2 to 3% consensus EPS upgrade, along with continued dividend, as well as buyback focus. So despite the grim macro picture, at the micro level, companies are generally doing not as bad as what we read from the paper. And quickly for Japan, we think in the medium to longer term, from the bottom-up perspective, the market is likely to focus on the likelihood of Japan-specific structural changes. For example, corporate reforms, as well as how companies will perform in an environment of higher inflationary numbers. Quickly on the Asian real estate market, I think generally the Asian real estate market, with the exception of China and Hong Kong, which of course suffer from some oversupply, especially residential market in China and obviously commercial market. Generally speaking, other markets are showing resilience because of supply bottleneck, and demand has not generally shrunk too significantly. And the rise in cap rates have actually caused some dislocations in certain sectors, but they are not as bad as what's happening in other regions, like in the US. And in Asia, logistics, data centers, and hospitality assets remain pretty strong favorites among investors. With that, I think the other thing I like to comment is Hong Kong, which has been a major market in the past, but obviously has not been doing quite well. But I think it's important to know that the really driver for Hong Kong are two. One is obviously with currency peg. Hong Kong is very much tied to the monetary cycle and interest rate cycle of the US. So with US interest rate going up, Hong Kong monetary situation is pretty tight and is usually bad for the asset market. And secondly, Hong Kong is driven by growth in China. And as we know, China has been in slow growth. So Hong Kong really were hit by both fronts. But with US interest rate cycle turning, and with China hopefully growth coming back to more palatable levels, Hong Kong's fortune could actually turn going forward. So just very quickly, even the current market situation, our investment focus currently are really in two areas. One is that we are looking at investing in Asian real estate REITs, real estate investment trust, essentially locking in the high current distribution, as well as benefiting from cap rate compression, rising asset value, and therefore, company managers will be able to recapitalize, acquire new yield enhancing or yield accretive properties to enhance equity growth. We are also working with partners to acquire resilient direct assets in developed market like Australia, with value added opportunities targeting in general low to mid teens kind of IRR and opportunities. The other opportunities we are looking at is really the data center, where we see very strong structural growth potential going forward. And with that, I will pass it back to the moderator. Thank you.
Thank you, Kiat Seng, for your interesting overview of the markets. I forgot to mention to the audience that there will be a Q&A session at the end of our presentations. And in order to feed the Q&A session with interesting questions, please use the chat in the Zoom platform to present us your questions so that we can pass them on to the individual speakers as we go along into the Q&A. And with this administrative remark, I would like to pass the baton to Professor Anand Kamat. He was gracefully ready to help us out 2 days ago when the initial speaker that we had lined up had to decline a presentation for personal reasons. So a big thank you to Professor Anand Kamat, who stepped into the slot. He is an assistant professor at the National Institute of Advanced Studies in Bangalore, India, and his primary interests are in the STS, particularly around subaltern socio-economic groups. Prior to the National Institute of Advanced Studies, he was faculty at the Azim Premji University for 6 years and has published 3 books and more than a dozen peer-reviewed journal articles. An academic through and through. Professor Anand Kamat, the floor is yours.
Thank you for the kind invitation. As I just mentioned earlier, I arrived here 2 days ago, and I hope to give a broad overview of the Indian economy. Let me just first share screen. Let me see whether this works. Share. Yes. Is this coming as full screen?
Yes, on my side it is. Thank you.
All right, good. And I hope this is now moving to the next slide. I hope this has moved to the next slide.
It has.
Good, thank you. Now I can go ahead. So once again, thank you to this to the group for welcoming me at the very last moment. I hope that I will do justice to the discussion. I want to present actually 2 sides of India in the Asian development and what it can contribute to the Asian development story. I must caution, of course, that this should not be seen as some sort of pessimism or any sort. It is mostly an overview of the Indian economy with a number of cautionary points. So that's why I have titled it as India, a box of opportunity or a Pandora's box, because in fact, the or is a bit of a misnomer. It is both a box of opportunities and a Pandora's box. Now, there is a lot of cause for optimism in the Indian economy. We have just been christened as the world's fifth largest economy. The popular discourse over here is quite exuberant. We're all very, very happy to gain this position. And we're also very happy that that the Indian economy has actually recovered back to pre-pandemic growth rates, which is actually quite stunning, considering how we actually suffered through the COVID pandemic, both in terms of economy as well as in terms of health. Our annual growth rate projections are quite high, nearly 8%. In the last quarter, in fact, it had shot up to about 7%. The last quarter of 2023, it had shot up to 7% or so. And our exports also, especially in high value manufacturing, in pharmaceuticals, have surged quite substantially by 8% in the last quarter. What is also interesting to see, according to the economic survey, it's a document it's a report that is released every year by the government of India before its annual budget. And it indicates that not only is private consumption expenditure high, which isn't surprising, but that household consumption of non-food goods, especially rural consumption of non-food goods, is going well. And why this is important is that it shows that the Indian economy is actually now, in real terms, transitioning into an economy where consumers, citizens as such, are moving into a higher value consumption, which actually is a very important stimulant for Indian economic growth, as well as for the Asian development story. What is also very, very promising, and this I would say with pride, not only as a scholar from India, but also as a scholar of STS, Science Technology Society, is that we have the largest proportion of digital financial transactions in the world. The digital penetration, especially for payments in India, is extremely high. And it is not at all an exaggeration. In fact, it has now become a fact of life that if you go out and buy something even off the street for a few rupees, it is very common to pay via mobile phone, even to the poorest person today. It's actually very common. These kind of digital transactions have really taken over as possibly, even I would say, the dominant form of payment in urban India, which is quite amazing. Also, something that actually was brought up was that we have also had a record sale of more than 100,000 housing units in 2023. And why this is important is because the construction sector has an innumerable number of spin-offs to all other sectors of the economy, and is also an indicator of aspiration in the Indian economy. And along with this, we are adding 10,000 kilometers of road every year. The number of airports in India has doubled since 2014. Also, we have a number of government schemes for the underprivileged in India, from cooking fuel all the way up to sanitation, and several other measures which are just too many to list over here. What's also very promising, and this again I say with some pride, is that the gigantic proportion of our population is of working age. The median age of the workforce is only 28, and the demographics show that we will remain a young country for some time to come, which I believe is actually, more than anything else I've spoken, this is our strongest point. The question, of course, has all this really translated into the well-being for the majority? It might seem a little out of place in this presentation among all of you to talk about something like this, but if such a powerhouse economy like what I've just described now, a powerhouse economy like this, if its foundations are not strong enough, will it really be able to contribute to the Asian development story? Will it be able to contribute to its own development story? For instance, the growth story in India has translated into employment gains mainly for those who are educated and skilled. And if only that were the case, that would be fine. But there are big wins for those who have been educated, and big losses for those who are less educated. And unfortunately, the large majority of the Indian workforce belongs to the second category. If you take the labor force, even though, of course, our economy has transitioned greatly, and like I said much earlier, rural consumption of non-food goods has gone up. Even then, we are primarily an agrarian economy, with 45% of the labor force in agriculture, 42% in services, and only 12% in industry. despite policy-led structural transformation. And what we have, unfortunately, is not the kind of service sector that comes to mind when we talk about service sector, but low-wage jobs in the urban economy constitute quite a bit of the service sector. 90% of the workforce is unfortunately in informal employment. There's low employment growth for those who are less educated, and the large majority of the workforce work for below subsistence rates. And when we say that there is a high share of self-employment, one should not actually mistake self-employment and misunderstand it as some sort of high value, high wage entrepreneurship. It is actually something that is done out of despair in the Indian economy, where there is a negligible amount of social security for the large share of the workforce. And also, as far as agriculture goes, we are dominated mostly by smallholding agriculture. And currently, the most critical issue in the Indian economy, that being agrarian distress, whereby the agrarian economy is actually has suffered greatly, so much so that people are moving out of distress from agriculture into low-end services. These are all notes for caution. To continue notes for caution, we must make a mark that we must mark over here that there is unfortunately a contraction in the manufacturing sector, whereby there have been, of course, contributions from the rest of Asia as well as from the West to look at India as a potential hub of manufacturing of high-end products, such as iPhones, for instance. But then that alone would not make us a manufacturing powerhouse. Now, what is also quite promising on the one hand is that this government has brought about about 4 years ago production-linked incentives for 14 sectors, mostly in high-end manufacturing, which are supposed to stimulate the economy. But unfortunately, on the other hand, they seem to be disconnected from the larger character of the workforce and disconnected from mostly from skilling. Our human development also looks something like this. I leave it to you to read this slide, whereby even in the global hunger index, we're not doing too well. We hold 25% of undernourished people in the world. And of course, our inequality story is also nothing much to boast about, where our number of billionaires increased by 1.5 times during the COVID pandemic, and the bottom 50% of the population hold only 6% of national wealth. Now, we have so much potential in terms of a labor surplus. We have an extraordinarily young labor force. As I said, the mean age is only 28. 63% of our workforce is 63% of our population is between the ages of 15 to 59, and therefore an explosion of prosperity should have happened. But then a note of caution here is that only 4.4% of the workforce is actually formally skilled, which is what is hindering us from actually translating that demographic dividend into economic development. And in fact, work is now going more and more precarious and towards the low quality service sector. In fact, the number of applicants for more permanent and more secure and high quality jobs is just too many. Now, what we also have, and I'll complete the cautionary note with this, is that we have a rather interesting case where social systems in India not only it's not just that social systems in India form a part of the economic systems, but social systems in India greatly regulate and determine economic systems at various levels and in all dimensions of the economy, whereby social relational inequalities deeply permeate into the economic system. Many of you in the audience over here would definitely be familiar with the whole idea of caste in India, which is a rigid, immovable, endogamous social set of social groups, which is the ultimate social identity in India. And we have a situation where one's caste impacts your mobility, it impacts access to infrastructure, credit, and it impacts even your access to information in the new, which is something which is very critical in the new economy. It impacts work distribution, it impacts labor segmentation, it in fact causes even severely differential remuneration. And what has happened is that, unfortunately, a lot of policy measures that were supposed to strengthen the Indian economy towards moving more towards a superpower has actually ended up strengthening pre-existing social hierarchies, where those in low value added work were unable to diversify. So we have even a large problem of unrecognized and unremunerated women's work. Now, of course, when I say all this, I must not be, of course, misunderstood as a scholar who has just brought out all the bad news. This is not the intention of whatever I had said now, because as you see in the first part of my presentation, I showed so much that is of promise, but then there is a lot to be cautioned about also. So I'd rather conclude on a more positive note of what is ahead. That is, I don't want to be over pessimistic because there's a lot to be optimistic about, but certainly if I could describe anything, the Indian economy is anything, it would be a high caution economy more than a high power economy. If the policy works diligently towards a decent employment regime, and if policy and the state actually figure out and install a solid social security system for workers, which is the need of the moment, we will definitely come ahead as a powerhouse economy and will contribute much more meaningfully to the Asian development story, much more than it is over now. We must, there are a lot of technology-centered incentives for the micro and the small sector, which is where most of India works, which is again quite promising in terms of its contribution to the Indian development story and the Asian. And what we need to do is, of course, move from growth maximization as the center of our development process to employment maximization. Because if we don't do that, then there is little meaning beyond the point about being the 5th largest economy in the world, which of course we are very happy about, but then we'd like that to be translated into something meaningful. Having a half-starved and a half-educated workforce is no good for the world's 5th largest economy, and certainly not good for Asia. So I would say that actually we have I've brought about, I hope I brought about a 50-50 split as to show how the Indian economy is actually a hugely potential contributor to the Asian and BRICS development, but there's a lot to be cautious about also. So I hope this hasn't deviated too far from the purpose of our conversation, but I think it's very important that we take stock of realities, social, political, and economic, before we promise anything as being a superpower nation to the Asian to the Asian economic story. So that's it. That's it from me. I hope this was informative. Let me just close the share. Stop sharing.
Thank you. Thank you, Professor Anand. I think this was most interesting, very candid, and I've heard a lot that I learned about now the Indian economy. I know, of course, the positive side, and I have had glimpses of the negative side, but I haven't seen it analyzed as deeply and as clearly. Thank you very much.
Thank you.
With this, I would like to go over to the next speaker, Professor Dr. Ouyang Min, Chinese economist. As a professor on economics at the School of Economics and Management of Tsinghua University, Ouyang's research crosses the boundaries of macroeconomics, microeconomics, and econometrics. She conducts both theoretical and empirical research, and her sole authored paper has been published in the Journal of Monetary Economics, the Review of Economics and Statistics, and Macroeconomic Dynamics. Her ongoing research projects include studying the influence of the property tax experiment in Shanghai and Chongqing on China housing prices, and exploring the impact of the 2008 Chinese fiscal stimulus plan on the macroeconomic performance of China. I can't wait to hear from Professor Ouyang about where China is going, because with its size and its dimensions, the influence is palpable. Professor Ouyang, the floor is yours.
Thank you very much for the invitation and for having me here. And I've learned a lot from the discussion of the two speakers who spoke before me. And thank you for the very nice introduction. I've done, yeah, I work at Tsinghua University. I teach in macroeconomics. I do research in macroeconomics, and my macro research is pretty much focusing on the micro foundation. So I study the microeconomics of the macro economy, industry organization, labor, and finance, all areas. And today, I'm very happy to have the honor to share my thoughts on the present and the future of the Chinese economy nowadays, and which probably has attracted a lot of research and policy attention in the past few years, and especially in this year. Okay, I'm gonna share my slides here, and let me know if you can see. Is it the full screen? Okay.
It works fine.
Okay. Just as a cautionary note, I think the investors are to be optimistic. Researchers are to be cautious. So please do not take my caution as pessimism. Okay, I'm just here to point out all the prospects and all the potential problems that should deserve a lot of policy and research attention, and hoping for a very bright future for China and for the world economy. Okay, and so apparently the Chinese economy has had a very brilliant past in the past 27 years, 25 years, 30 years, and it has been considered as the growth engine for the global economy. We played a very important role for the post-2008 recovery of the world economy. We have grown into the second largest economy, and the IMF has provided some estimations lately saying if we adjust for differences in certain costs, China's share of the world economy actually is bigger than the US. They estimate that the US contribution to the world economy should be around 15%, and China can be as large as 18%. Okay, so that was the brilliant past we have had, and everybody has witnessed. Unfortunately, or fortunately at the very beginning, we thought we had the best policy around the world to deal with the pandemic in 2021. Zero COVID policy. We did quite well for about a year. And then in 2022, we realized that policy is really restricting everybody in and is not going anywhere while the rest of the world started to recover and started to open up. Fortunately, the Chinese government ended the policy very quickly after observing all the successes in the Western economy in the US and in Europe by December of 2022. Okay, great. We had some successes and we had some mistakes. And now the pandemic is over and everybody's hoping for a very, very quick recovery for the Chinese economy to return to the role of the growth engine of the entire world again. And this figure shows the past, the present, and the predicted future since 2013. And the year of 2013 is a very, very important year because that's the year that the President Xi initiated the anti-corruption campaign, the biggest anti-corruption campaign ever in the history. And that's a very important political event that has very big economic impact. I'm going to come back to that later because it brings a big scarring effect on the policy right now. Okay, so before 2013, that this figure shows the growth miracle of China was even more spectacular because we were growing at 10% for years. And starting from 2013, it slowed down a little bit to 8%, 7%, still very impressive. Okay, so in 2015, we had a stock market crash. And we managed, or we tried very hard to recover. And the growth rate remained at around 7% or 6%. In 2019, right before the pandemic, we were going down to 6%, still, relative to the rest of the world, still quite impressive. Not as high as 8% of India this year, That's still quite impressive. And in 2020, everybody knew what happened. The pandemic started. And the zero COVID policy seemed to work very well at the very beginning in 2021. So the growth rate surged to 8.45%. And the zero COVID policy turned out to be working not so well again very soon in 2022, so we dropped. So that was the special years of the pandemic. In 2023, the first year post-pandemic, GDP growth recovered to 5.24%. And we had very, very high hopes for 2024. We thought that was just the first year post the pandemic. We thought, we had a whole year for people to adjust their behavior, to adjust their expectations. And then 2024 should, be as spectacular, as brilliant as the past. And this was the prediction by IMF back in 2023. We were hoping, the world was hoping that China would be the growth engine for the world economy again, because the contribution of an economist growth to the world economy growth would be the growth rate of China multiplied by the share of Chinese economy of the world economy. And as I mentioned in the first slide, that the China's share can be bigger than the share of the US. The US share is estimated to be about 15% after adjusting for some cost. China's share can be 18%, but even if we just set the two shares as equal, around 15%, China's growth rate is much, much higher than the US growth rate, even now. So that means we would have twice as big of a contribution to the world economic growth. And the estimation or the expectation everybody gave for the annual GDP growth rate for 2024 was set at a presumably cautionary estimation of 5.1%. I said, okay, even if the Chinese economy was only going to grow at 5.1%, and China's contribution to the rest of the world would still be as much, twice as much as that of the US. That's our hope. And we thought that was a cautious hope. It turned out, oh my God, 2024, the year of 2024, after a whole year of adjustment in expectations and behaviors and the market, so far, it has gone a lot worse than the year right after the pandemic. And this is the number I just put together last night. In the first quarter of 2024, so the target was about 5.1%, maybe 5%. In the first quarter, we had 5.3%. Things were starting to look good. We thought we can make it. Okay, maybe the first quarter is only 5.3, then we can have even 6% or 7%. So easily reaching the goal of 5.1%. Things has not been going that well since the second quarter. My personal experience is I put one of my houses on the market, and the offering price I got from the potential buyers has been going lower and lower. So in the second quarter, it turned out the GDP quarterly annual growth rate is only 7.3%, 4.7%. It presented a challenge that whether the Chinese economy could ever reach the presumably cautious goal of 5.1%. And here are the detailed decompositions of the GDP growth. Manufacturing value added was declining from 7% to 5.1%. The retail sales were really going downward. The fixed asset investment was going downward. Residential investment was going downward. Exported goods, exports actually started to go up a little bit. That is something I'm going to come back later. CPI remained slightly positive growth rate, but PPI shows deflation. That is a really, really not so good of a signal that probably put a lot of people starting to worry. And the unemployment rate here showing just around 5%, but this unemployment rate is something that the Chinese statisticians or statistical government agencies are still working very hard to make it more accurate to reflect the real state of the economy. The labor market in China right now is not going that well. So I'm going to go through, most of these categories one by one to provide a more detailed picture of what's going on. This shows the retail growth. Good years for 2023 was actually good, a very good year. Now looking backward, we were hoping for a good recovery, a quick and big recovery, or even, more growth, further growth in retail sales for 2024. No, it's going downward, okay? This is what's been going on for retail sales. And if we look even further to the micro level, the big cities, we know Beijing, Shanghai, Guangzhou, Shenzhen, 4 of the biggest cities in China, and their retail growth has gone really negative in the past few months. Okay, it was positive, and early on in April, was positive early on this year, and it has gone really negative, especially Beijing, and Shanghai. Shanghai has done really, really not so well. And this is the real estate investment growth. So here are the pandemic years. And here is the year right after the pandemic. It recovered in 2023, but it has been going downward very steadily since the year of 2023 and going way downward for the year 2024. Okay, so here is the manufacturing PMI, purchasing managers index, showing a low confidence. We're showing the year pre the COVID, and we're showing the year after the COVID. We're not showing the data for the year of 2022 because that's the year that the Chinese economy was really locked down. And again, the curve for the present for the year of 2024 is really, especially for construction PMI, is really showing to be the lowest among all these years, worse than the pre-pandemic and worse than the year of 2023. And due to all these facts, everybody's predicting even lower growth for the future. I think the Chinese government or the rest of the world are not having high expectations for the rest of the 2024, and we're probably predicting that the growth rate, quarterly growth rate for next few quarters is gonna just be around 4%. We probably won't be able to reach the target of 5%, and that's the expectation. And the worst facts of the Chinese economy right now is deflation. This figure shows the growth rate in GDP deflator or the GDP deflator-based inflation rate, negative. And this shows the CPI level and PPI level. CPI still shows positive growth rate or inflation, but PPI is showing deflation. Okay, deflation can be very dangerous and is being very dangerous right now, as we all observe for China. What's going on right now is due to deflation and due to the expectation that price may go even lower soon, firms are reluctant to purchase or invest because the price may go even lower. I'm gonna wait. Households are reluctant to spend because the price is gonna go even lower. I'm gonna wait. I'm not gonna buy houses even if I have the money because the price can go even lower. If I buy right now, I'm gonna, lose the value. Banks are reluctant to extend loans, although the government is encouraging all the commercial banks to lend. And then what can they do? They are just gonna lend to SOEs because that's safer. So the bias we had regarding only lending or lending more to the SOEs turned out to be even stronger nowadays. And the real burden for the deflation is that the real burden of any nominal debt that we have accumulated during the pandemic, both in public and private sectors, has becoming even tougher to manage. So these two Ds, deflation plus debts, all together, combined together, create a very, very negative cycle. So we have lower demand due to deflation. And due to lower demand, we have lower investment, and then we have lower income. And then lower income creates even lower demand. So this cycle has been going on right now in the real estate market, in the manufacturing sector, in the service sector, and in the retail sector. So that's really what's going on, what I observe as a Chinese resident right now. All right, we want to save the economy. How to save the economy? We've had past periods of deflation for the Chinese economy. So that was, in 1999, and then China joined the WTO. We had started the growth miracle. In the year of 2015, the Chinese stock market crashed. And look, the real GDP growth actually remained quite flat since that stock market crash. But the nominal GDP went higher due to the fact that government managed to stimulate housing market. Okay, housing price was going really high. When the housing price remained high or growing, actually that brings some confidence, at least to the household side and to the investor side. And this is the pandemic. And now, starting from 2023, we are having this periods of deflation, and we're still struggling over here. Okay. The economists around the world and in China, including me, including my colleagues at Tsinghua University, we have urged the Chinese government, we have to do whatever it takes to rescue the economy. We cannot let this negative cycle to keep going. And the Chinese government has done something, I have to say, because I've been, following all their policies. And for example, it relaxed the purchasing limits they imposed on housing to control the housing prices for years. And they cut the interest rate. And however, all these policy steps has been very, very tiny. It turned out that the current administration has been very, very cautious, not as aggressive as the past administration like Zhu Rongji. And I think there are several factors that are contributing to current caution of the current administration. Government does have strong incentives to rescue the economy, but they worry about whether a strong approach would be as effective as the past. So they say, okay, what if I do a lot? And then that's not going to take any effect. And then people's hopes or expectations are really going to get crashed down. And so they're trying to do tiny steps to manage the expectation. And I personally think, and I think a lot of my colleagues would agree with me, is the anti-corruption campaign initiated in 2013 has made the current government officials very, very cautious in taking any big steps, both in local governments and in central government, because they feel like if I do a lot, I might run into some, regulation ambiguities. So I prefer not to do much. The less I do, the less danger I would encounter. All right. One thing that we have to, one aspect I have to point it out is, although the retail sales, residential investment, construction all have been going downward, export turns out to be important still. Look, this is the one that has started to recover for the year of 2024. And we were making some predictions about the monthly growth in export, and for the August of 2024, it actually went higher than we estimated. Okay, so we were talking about the three engines of the Chinese economy: investment, consumption or government spending, and export. And for quite some years, the Chinese government talking about, we should boost the domestic economy to make our economy less dependent on the rest of the world. But it turned out maybe net export still the possible way to boost the Chinese economy. But can export rescue the Chinese economy? Maybe yes, maybe no. I want to be more optimistic here because, the Chinese manufacturing goods remain as an important contributor to the rest of the world. And because a lot of the economies, including the US and European economies, are experiencing high inflation, okay? So excluding Chinese goods is not gonna help to control the inflation going on in Western economies. However, there has been an anti-China momentum building up still in the US and in Europe, like the TikTok, like the anti-subsidy EV industry investigation against the China's EV industry. And the global value chain has been shifting to India, to Vietnam, and to many other economies. But I want to put a cautionary note here. I'm not so sure that those economies can fully replace the role of China in the past 30 years, because there's still a lot of resilience in the Chinese economy. The other economy may not fully have. So all these are challenges we have. And the problem is these challenges actually are quite new. They are unlike any of the challenges that the Chinese government and Chinese people have dealt with in the past. One thing that really worries me personally is I've observed pessimism among Chinese people, especially among young people like my student. They have been, they tend to stay in the house. They tend to talking about lying down and relax. They would talk about, okay, even if I fight hard, I'm not gonna win. Why not just, relax and enjoy life? And the young people they're not, they don't date. They're not getting married. They're talking about no kids. And there has been a declining fertility rate. And the youth unemployment rate has been very high. College graduates are facing difficulties of getting jobs. And many college graduates just quit the labor force. They stopped looking. However, I want to put some optimistic notes here, just like the first speaker mentioned. On the macro level, the Chinese economy looks very, very not so well, doing well. But at the micro level, the firms may not be performing as bad as it appears at the macro level. So what I was told yesterday, actually, I was teaching my intermediate macro class. So I asked my students right there, I said, look, I know many of you are talking about you cannot find jobs. Is it really you cannot get any jobs? Or is it just you cannot get jobs that you wanted? They say, oh, if we want just one jobs, we have plenty of options there. It's just we're not getting the ones we were hoping to get. So job opportunities is still there. It's just whether the young generation can adjust the expectations to fit in the new era. Okay, I've had an article called The Scarring Effect of Recessions in the past. And I would say the present of the Chinese economy bears the scarring effects of many past problems, like the zero COVID policy, like the overcapacity of certain traditional sectors, like the frictions in the financial sector, like the anti-corruption campaign initiated in 2013 that has made the current government administration very cautious in implementing any policies. And also we've had long-standing problems in the R&D sector and the innovative activities that are not really innovative or focusing on the basic research and development. So how about the future? Oh, I want to say, despite all these seemingly pessimistic notes, I personally remain optimistic about the future of the Chinese economy, because China remains as the biggest contributor to the world economy, if not the biggest or the second biggest. And the importance of the Chinese economy will not diminish due to its size. And that's very different from Japan, from the Japanese economy or the Indian economy. And the future of the Chinese economy lies in the hands of the Chinese government and the Chinese people. Let me to be more specific. I think and I believe the government will become more aggressive in terms of stimulating the economy and taking policy steps like expansionary monetary policy plus the expansionary fiscal policy combined. And we had a very, very strong and powerful government. They can pretty much achieve a lot of the goals if they set their minds to. And the Chinese people is what make the miracle possible for the past 30 years. They are one of the most hardworking people around the world. They are probably losing a little bit of a hope for the moment, but as long as they can come back to their usual state, I think they will create the miracle again. For example, the EV industry that has impressed the rest of the world, the electronic vehicles that the Chinese companies has produced has surpassed many of the other EVs by the US and by Europe. And so I believe in the resilience of the Chinese economy, and I'm hoping for the resilience of the Chinese economy, and I hope you will agree with me. And that's all I have for today.
Thank you, Professor Wu Yang. That was most interesting. I had some very interesting takeaways and my own questions, if nobody else will ask questions. But before going into questions, I would like to pass the word on to Mats Pedersen. Mats is specialized in asset management, portfolio construction, global economics, and politics. He is a co-author of Allocating for Impact, G8 Social Impact Investment Task Force Working Paper of 2014. He's the co-author of What's in the News, Using News Sentiment Momentum for Tactical Asset Allocation in the Journal of Portfolio Management in 2015. Mats is a regular contributor on Bloomberg and is a highly regarded portfolio construction manager all over the world. Mats, the floor is yours to wrap it up.
Thank you very much, Urs. Thank you very much for the invitation, and thank you very much to the other speakers. Very interesting words. Especially, I must say, I'm very, very impressed about the detailed amount of Ds we have heard about in China just now. Let me try to check. Can you all hear me now? Am I going through clearly? Good. So let's go back to what Urs initially set us up with, which was starting with August the 5th. And what happened at that time. So I will give you my interpretation. As always with markets, it's a little difficult, borderlining impossible to say what actually happened and what triggered what, but let me explain what I think happened. For a very, very long time, there has been a very cheap carry trade. And what we know in finance is that if you think of the typical person like me, we are not very good at understanding our own risk capacity and the risk we build up in our trades. The longer it goes, the less able we are to assess the correct risk, because we have a tendency of looking at mathematical formulas which are based on what happened before, recently or not so recently. So we can use value at risk, we can use volatility, but if there hasn't been anything happening lately, we won't have a good sample going back in history. As I see it, what happened is that we had a movement in markets. In general, remember, equity markets are in the late stage of a very powerful bull market. And the most important equity market in the world, S&P 500, is up 100% the last 5 years. This has accumulated a lot of risk in markets because there has only been very few real drawdowns. In Asia, specifically in Japan, we've had a carry trade which was relatively inexpensive to hold on to. And then we have had the Fed tightening monetary policy around the world. I'm of the belief that that's one of the things which unwound the Chinese housing because they increased interest rates. But what happened in this case was that markets were very positive. People have built up very large structured product or derivative positions in stuff like Nvidia, Tesla, and the Nikkei. So what we see is that these risk triggers are being breached. We see a cascading effect, and from Sunday to Monday, basically people try to get out of their trades. As they cannot get out of their trades in the Japanese market, they are trading into the futures. So the chart I wrote in my note that morning was showing the futures, how you can see first the Nikkei, then the Kospi and the Taiwanese. And when there's no more risk capacity, people start hedging off their risk in S&P 500 and in NASDAQ. we can see the recovery afterwards, as it was mentioned, was relatively swift. So if we go to the next question, which was posted to me, where could something like this happen in Asia, and could it have a global impact? In 2016, I was interviewed to the Financial Times with a question, how do I start my day? And what I told, if you remember, if we go back to 2015, as we just heard, there was a not so good development in China. What I told FT was, the first thing I do in the morning is I look at the exchange rate between the renminbi and the dollar. When I know what the exchange rate is, I know how long my morning run has to be, how much stress there is in the financial market, and how much I need to exercise before I can think clearly again. And I think we're still in the situation where the two obvious risks areas is if Hong Kong were to let the peg go, because the peg has been in place for a very long time, the peg to the dollar, a lot of risk, a lot of people will have dollar debt, but Hong Kong income, and the same, of course, in a larger scale with China. If China tries to solve the problems they have, which we heard about a lot before, so let me not get into details about things I don't know as much about as the previous speaker, but if they're trying to unwind it by letting the currency go, then we will see a spiraling effect. And I think the S&P will be down 15% in a week. I think, though, that the Hong Kong market is probably going to be down 40. And in between there, we're going to have Germany, Sweden down something along the same way, because this has nothing to do with what's Hong Kong or not Hong Kong, whether it's Chinese or not Chinese, has to do with it's a cyclical market, just like the Swedish, the Brazilian, and the German markets. It has to do with the composition of the companies, not about people's ethnicity or anything like that when the financial markets, they unwind. So that is where I would be cautious. If we then look at the events, what I said on Monday on Bloomberg was that I think a 50 basis points cut from the Fed is very much warranted, and it would be a decisive cut. Now we got that cut. So assuming that in Asia, the biggest risk would be an unorderly unwounding of the currency situation, simply because that's been running the longest time and there's most risk associated with, well, then the clear positive for Asia, for China, and for Hong Kong here is that actually the ones who need the Fed to cut the most are the ones who are most into a debt negative situation or to non-growth. So the most release, and this is also what we saw in the morning reaction, the Nikkei goes up and the Hong Kong market goes up because we get a monetary release. So this is the positive. This is the positive effect we have seen. We then have the question to ask ourselves, if we just look at the data, the Chinese market, for example, is down 50% from the peak if we look at MSCI China. One important question to hear is that halfway to zero? Or is that the same buying opportunity as we have seen in the US? Because the US was down 50%, actually 57% at the bottom of the great financial crisis. And I think only the Chinese politicians can really decide, just like you needed the American politicians to step in that time and correct their direction. Only the Chinese can really decide if this is halfway to zero or if this is a buying opportunity with 100% upside in the next 3 years. But if we look then at what is going on in China, I think there's an interesting observation which links Germany and China. And that is, as I wrote in my monthly note not too long ago, the two largest investors in Mercedes, they're actually Chinese. Not so many of my German friends knew that, so they were quite surprised about that. But if we look at the story we heard just before about the beautiful Chinese EVs now, the beautiful cars, I think you can think of it as like this. You have a Mercedes technology, you have Porsche design. I'm not a car fanatic, so I don't know, but I can see that a lot of the new Chinese cars, they look like a Porsche, and you sell them at Volkswagen pricing. So that's quite impressive as an engineering achievement from China. The big question I would then pose here is, can the world, so let's say we produce luxury cars in China at very affordable prices. The question which I cannot answer is, will Harris and Trump accept them to come into the US? It's not such a big export market. Will Mercedes CEO, who has the two largest shareholders being Chinese, keep saying that we should not have a trade war with China? And will he win that conversation, or will we get the European Commission's answer to that? That's not my decision. That's just a risk I see in the market, because we have these amazing Chinese cars, but we also have an amazing amount of people around a little town called Wolfsburg. There's 303,000 people who works for Volkswagen there, and they seem to think that they would like to keep their jobs. So we have a conflict. As a portfolio manager, my answer to this question is not who's good or who's bad, it's what is the risk. At the moment, my portfolios are positioned globally with very large overweight in US, very large overweight in technology. We have a lot of companies there which are earning a lot of money. We have what could make me more positive on China, where I have 0 now, is if the Fed does a few more of these cuts, then the balance of risk for the economies which are in kind of liquidity tightropes increases, and that would make me more positive on China. But where I am positioned now, and if I look at the stories, I'm in the US, I'm buying and holding US equities, which are benefiting from the earnings drive into technology, where $1 was spent on Coca-Cola and is now spent on watching TikTok on an iPhone. Well, that generates double the revenue for the IT companies. The same revenue, but double the earnings. What I would say is the long-term stories I'm looking at in Asia is for my domestic growth story. I agree with our speaker earlier. India is a fantastic domestic growth story. It's very much a domestic story, and it's a very positive story. The man who taught me most about Asian economics is a guy called Christopher Woods. He helped me in 2000 write a report about WTO as China entered. He's been 20 years positive on India, and he still is very positive on India. I'll be catching up with him over my ski holiday in Switzerland in January, and I think we're gonna focus on India as the domestic growth story. The technology growth story is Taiwan. The consumer group growth story to me is Korea, because I see a lot of the Samsung story as being linked to the ability of Korea to manufacture consumer goods, and the big potential. And that's really, as we heard before, up to the politicians. The big potential is China, but it has a potential to go the wrong way if the politicians want. But it also, because it's down 50% MSCI China, it has an amazing opportunity to improve the politics now and to make the 50% distance to the bottom being a 50% distance to 100% gain. You know, if you buy now and you make it back, we're up 100%, and there lies the conflict. I would be a little bit, if I may say something not too controversial, I think making friends with North Korea and Russia is less beneficial than making life conditions better for the domestic population, as we've heard. So I think focusing on solving the present problems of the 2Ds, the debt and the deflation, is very much the way forward, and that can reignite the optimism from people like me. But to be honest, until now, I come from a small country like Denmark. I have lived in Switzerland and London. Today I'm speaking from Madrid. Looking at what goes on is a little bit scary, and there's not so much clarity. So clarity and tackling of the problems is the potential. For now, I would be more happy to put my money to Taiwan, to India, and to Korea, and have China as the big opportunity. And this is basically, as much as Fed keeps easing the situation for what we could call potential growth countries to live up to their potential. So these countries we're talking about growth potential from an accelerating pace, like India, is getting better and better. So everyone gets help from the Fed cutting rates. I do it in my US dollar portfolio, but it also makes the rest of the world more interesting. That's my speak for today. Thank you very much for the attention.
Thank you, Mats, for your very enlightening comments. With this, I would like to go into the Q&A session, and I just arbitrarily start to jump into one of the most controversial issues that I just have heard. I've heard Mats say that if Hong Kong gives up its currency peg, that the Hong Kong markets will drop 40% and the S&P 15% as one of the stories. I heard Kiat Zhang say that Hong Kong's big future depends a little bit on the currency peg and on its relation with China. So I would like to hear from Kiat Zhang maybe what is his personal view? Will the currency peg in Hong Kong hold? And if so, how long will it hold?
No, my my comment was really that Hong Kong, market is driven by two factors, predominantly, not exclusively, of course. Firstly, growth from China, and secondly, the U.S. Interest rate cycle because of the currency peg. And I think the short answer is, in the foreseeable future, I don't think the peg will go. Just because there's no alternative. I think 10, 15 years ago, as China was doing well, the market was talking about, potentially of a depegging. But I think since then, the market has not been talking about, anything like that. So I don't think it's going to happen in the foreseeable future.
Thank you. And likewise, of course, the same question would be interesting to be seen from the angle of Professor Wu Yang. What do you think? Will the currency peg in Hong Kong hold, or how do you see the future there?
I'm not an expert in this area because I'm more like a real economy kind of a researcher, but I do think that Hong Kong's role is very special for the rest of the world and for China. I think during the pandemic and a few years before the pandemic, we thought the importance of Hong Kong was declining for China. We thought that Shanghai was taking over. We thought that Singapore was going to take over. It turned out, Hong Kong is still very, very important. And I do think that the currency exchange regime will remain the same as in the past, in the present, for quite some time for Hong Kong. The administration of both Hong Kong and Central China is not going to do much at this moment because that runs into big risks. And I do believe that the future of the Hong Kong economy relies heavily on the prospect of the domestic economy of China. Yeah, it's a tight relation there.
Okay, and maybe if you allow me a follow-up question also to you, Professor Wu Yang. I thought I heard from Mats that he was saying the China risk or the China future has also a relatively large dependence on the Federal Reserve in the US cutting its rates. So there's two elements in his story: the cutting of the rates of the Fed and the actions, let's say, of the Chinese government to deal with the two big Ds, deflation and debt. How do you see this interdependence? Is the Fed rate an important factor? And how do you see the Fed rate go if that is the case?
You are the third person to ask me this question today because the rate cut happened last night. The first person who asked me this question is my real estate agent. And he's been trying to sell my house for a whole year. He said, Professor Ouyang, do you think that we will, have a better prospect of selling your house? Because we have this rate cut. I think we're hoping that the money will, just flow back to China. To be honest, I personally do not believe this rate cut in the short run will have a very big impact on the Chinese economy, because the big problem we have is confidence, is the lack of confidence. And that rate cut is not going to boost our confidence anytime soon, maybe after, a few cuts down the road. One thing that I would like to point it out is the capital control of the Chinese government to preventing money from flowing out of China has been a lot tighter in the past 2 years. It will become even impossible for the billionaires to get their money out of China to invest in the US economy or in the Indian economy, because the Chinese government was trying to use the administrative power to prevent the outflow of capital. And so would the capital be able to inflow back as freely as they want due to the present still lacked confidence. I think it will take some time at least.
Thank you. Interesting issues. I heard from the audience the question, and I would address it to Kiat Seng, but please, every one of the speaker panel, feel free to kick in. Where does Japan and the Japanese economy fit into all these scenarios that we see about to happen in China, in Asia? Kiat Seng, maybe you take it.
Well, I think just very briefly, Japan is obviously benefiting from fund flows as a result of, as insofar as Asia is concerned, as global capital, shuns China, and China is a big market, and I think Japan obviously is a large economy in Asia. And I think with a weak yen, obviously things are very cheap, hospitality, real estate, and so on and so forth. So I think Japan has enjoyed a good run. I think until the recent past, Japan, the yen has been used as a cheap currency to fund other assets. And I think if we are going to see a more stable yen as a result of the US dollar, not strengthening further as a result of interest rate coming down, then I guess interest in Japan will continue to be quite strong. I think Japan has always been they have quite a number of strong global multinationals. In the automotive sector, in the component sector, there's very strong ecosystem. But in the EV era, they have not been, I guess, showing competitiveness. Obviously, they are, placing their bet on, hydrogen, vehicles. So I think Japan as a whole will continue to to move along, as part of the, I guess, alternative global supply chain aligning with US and so on. But I think obviously the drawback is the aging population, and how strong the future prime minister or policy decision makers will continue to reform the sector, the economy. I think Japan obviously is currently is in a new scheme of things, in a new economy. It has not been so far has not been outstanding, and in many areas have been overtaken by China. So I think we are yet to see. But obviously, they have a very strong, I suppose, domestic asset market that currently enjoying very strong fund flows.
Thank you. Then a question to Professor Anand Kamat. We have heard that the growth story in India is more a local growth story. When will the local growth story become a global or multinational growth story? And what can India do to supercharge its economy to reach a level of poverty reduction that will satisfy the citizens of India?
I'm going to borrow a statement which was made by Amartya Sen. This is not my own. He said the best way to describe the best way to describe India is islands of California within a sea of sub-Saharan Africa. And that, unfortunately, is what India really looks like. That the Indian growth story is mostly among these islands. It is not a pan-Indian growth story, unfortunately. The metrics used to calculate development and growth at the national level do not really take into account this sort of sea of inequality that we have. I think if we need to make some difference, not only to ourselves, but also to the international community in Asia, as well as the BRICS community, I think we need to do much, much more work. And not only myself, but a large number of economists and social scientists believe that we need a much, much more committed policy towards education. And it's a rather strange thing that we're talking about such fundamental elements in this day and age. This is something that developing countries used to talk about almost 100 years ago, when slowly, when colonialism was slowly falling down, then each one took charge of their own education and healthcare and so on. And we're still talking about this in 2024, which is a rather sad story. There has to be a far more committed resolve towards rectifying the very broken healthcare system, because like what commentators have said, we have mostly a half-educated and half-starved and undernourished workforce. If we need to do anything of significance, we need to make our fundamentals strong, and our fundamentals can be strong only with further commitment. And there's little point in just looking only at these islands of California. They are not India, they're just islands within India.
Thank you, Professor Anand. With this, I want to go to another question to Professor Ouyang. The audience is asking, when you say you don't buy a house, is that from an investment point of view, or is that from a household point of view? And I guess he's referring to his contacts who seem to all own more than 10 flats and who seem to have made their investment decisions based on the demographics and not based on interest rates. How do you see that when you make a decision that you are personally now selling your house? What is that based on?
I totally agree. I don't think interest rate plays a big role in the decision of buying a house among Chinese people. They buy a house because they see, the prospects of a housing market, maybe due to demographics, maybe due to something else. And people bought houses. I think the one who bought over 10 flats probably did it, at least 15 years ago or 10 years ago, when the housing purchasing limits were not imposed strictly. So they were able to get around all these regulations to buy a lot of houses. And then the restrictions were imposed very, very heavily on the number of flats you can ever buy. And when we say currently people don't buy houses, it's both from the investor's point of view and from the resident's point of view, I would say. Of course, when people are worrying about deflation, including declining housing prices, investors are not going to buy houses because that means losing money. But for residents who probably want a bigger flat, to improve my life, to live in a better place, they are also hesitating because maybe I wait a little bit, I can buy the same house at a little lower price. So this is why the deflation is really hurting the economy. Even if people have the capacity to consume, even people have the demand capacity, it's just not being realized because everybody enter the game of waiting. And then sluggish demand, sluggish price, sluggish expectation, and even slower growth, and then even lower demand. So we enter this really, really bad negative cycle. So the quick answer to this is, I think all these views are right. There has been a lot of dynamics going on, and the key point here is still deflation, because deflation hurts the confidence of both investors and just the regular residential purchasers of houses in China.
Thank you, Professor Ouyang. And maybe a last question to Mats. If all the Asian governments would be your personal friends and they would have to listen to you, you would be the ultimate autocrat. What would you tell them to do, such as to make their economies become brilliant engines of growth?
That's a simple question. Thank you very much. I would tell them to look carefully at what the largest financial and economic miracles in the region have shown. So we have the first one, if we look at the modern economics, was Japan. And then we have the Asian tigers, and now we have the largest in volume until now being the Chinese one, and then hopefully and probably India coming. If we look at the largest miracle in India now, maybe it's the digitalization, the fact that people have an identity both as a person, but also in the economy is helping a lot. And we heard how this helps the transactions. So making people have equity in the recovery or the growth miracle, opening up for what people really want, which is to own their property, own their pension, and own their future with education for their kids. Those who have kids, I happen not to have kids, but I can still respect those who have kids. Do that in the way which we saw an extremely positive development in the Asian tigers with the different characteristics, and also in 30 years of Chinese miracle, which is now then being transferred partly into. So take the biggest drivers of individual freedom within your religious context, because this has happened across many different religions. Yeah, there's not much similarity with the religions that happens within India and what happened in Korea, but there are some. But mainly, it's a question of respecting the society, but growing the ability to the individual person to grow their wealth, their freedom, and their ambitions for the next generations. So that is another way of saying, Xi, maybe you should step back a little bit from Mr. Xi knows better than everyone else, and actually let everyone else know a little bit better about their own life.
Okay, and I think with this, I would like to thank all the speakers. I think this was a very, very insightful presentation of everyone. I have a lot of things that I take home with it, and I would like to thank all the participants. Thank you for listening in. We will create a short summary of today's webinar and try to circulate it. You will also get it. And with this, I would like to close almost on time. And thank you for your participation. Thank you very much.
Thank you.
Thank you. Thank you, everyone.